Good afternoon, all, and welcome to this KBA SME Inuka webinar. We are delighted to host you this afternoon to discuss matters touching on taxation. And I would like to welcome you to this session. Thank you for your participation. I think we are ready to start our session. And with us here to discuss this matter touching on taxation is a seasoned tax expert by the name Wilfred Alambo, who is a High Court advocate of Kenya and a certified public accountant, and is currently working as a group tax manager for Equity Bank. I think most of us, we may have seen reports in the media about some businesses facing tax challenges. And tax concerns has been a topical issue, either as a taxpayer or as a citizen. And it is in this regard that we opted to have this discussion, just to share with you insights of how to navigate and understanding of the taxation landscape in the country. So it becomes an imperative issue as a business owner in terms of how do you manage your tax obligation for you to be able to comply with the various tax requirements so that you can manage your businesses without facing the challenges from the tax revenue. So to unpack this topic on taxation, our key speaker will take us through the understanding of what tax entails, the various tax categories, how to plan for management of your tax affairs, and also how to engage with KRA in the event of a tax dispute arising from assessment of your business. So mine is to welcome you to listen to the speaker and to make the session of much benefit to yourself. We encourage you to post any questions that you may have relating to the subject of discussion to the group chat, so that at the end of the session, our speaker can address some of those questions that you have posted. So take advantage to post any concerns or questions that may be of concern to you relating to the discussion. So without much ado, I want to welcome our speaker, Mr. Wilfred Alambo, to take us through his presentation on understanding and navigating taxation as a business owner. So welcome, and once again, post any queries or concerns that you may have relating to the subject. So over to you, Wilfred.
Thank you, Ken, and welcome everybody and good afternoon. Ken effectively has captured exactly what the discussion for today is. And as you said, I wouldn't claim to be a seasoned tax expert because tax changes and it's inevitable. So there's always something new to learn about tax. There's always something new that is coming up. There's always something different that happens about the law. And as he has mentioned, I'm an advocate of the High Court and a certified public accountant. And before I joined Equity as the group tax manager, I was also a tax consultant. So I'll try as much as I can to break it down for you. So if there is a question that comes to mind as I walk you through the tax issues that you need to know, please note them down, and you can even include them as queries on the Q&A so that the thought process continues even when we finished and your question is captured at the end of this. So I would say, like everybody else, tax is indeed complicated, but sometimes you can, as much as you can, try and simplify it to the best way, because ultimately it's inevitable, it's as certain as death, and you will always have taxation in any government as long as there is a government. So I will proceed to the presentation and feel free to note any issues that you want but I'll take the questions and provide the answers towards the end, so that at least I can comprehensively cover your needs and capture what you would like to know, even as we walk through these issues together in the next 45 minutes to 1 hour. Thank you. Please allow me to put off my video for purposes of presentation to make it easy. So the objective of this specific session is actually to give you the basics of what tax is, what laws effectively guide taxes in our country, and then try and pinpoint certain areas that, being an SME, you would have effectively to understand for purposes of certain specific taxes that effectively will affect you as a business owner, or even as an entrepreneur, for purposes of the economy and the industry within which you work with, so that you're able to understand how these taxes therefore consequently impact on your business, and then how then can you plan your affairs effectively and efficiently to not only comply with the laws that are provided for purposes of taxation, but you are then able to take advantage of any incentives that are provided. You're able to manage your affairs efficiently to ensure that, therefore, the taxes that you're paying are what is legally required of you, so you don't underpay your taxes and therefore get penalized for it, or overpay your taxes and have challenges getting refunds, or just end up getting a higher expense than you ought to. And then how then you go forward to manage any risks or mitigate any gaps that your business faces in relation to your business affairs, for purposes of ensuring that all risks that are related to your business in relation to taxes are effectively managed, are effectively mitigated, and if they do arise, effectively dealt with for purposes of ensuring the continuity of your business. The reason I say this is because as long as the KRA continues being aggressive, increasing its capacity, trying to increase compliance, there are certain gaps, there are certain measures, and there are certain instances where they will try and generate as much revenue as they can. So presently, you'll find that the most focus is usually on the big business and employees. But as time goes by, and in the expansion and the spirit of expanding the tax base, it is inevitable that the Revenue Authority will extend its arm to all other sectors that generally we would call informal sectors, which generally also referred to as the micro, small, and medium enterprises, for purposes of closing the revenue gap that we have, to ensure that, of course, our debts are paid, our government officials are paid, and the state runs as it should, because that is the only way a government can run. So it has to generate revenue one way or the other. Then, because of these laws that we have, the efficiencies and the compliance that we need to do, it is inevitable that disputes will arise. So I'll also do a quick walkthrough on how an audit would arise and how this therefore would generate to a tax dispute, and how then you resolve it through the processes and forums that are provided under law. Rosalind, the next slide. So just to give you a background, there is nothing that will happen in any country without the provisions of law. And there's actually a maxim that lawyers use, that as an individual, you can do anything under the sun, as long as it's not prohibited by law. But as a government, you cannot do anything under the sun unless the law provides for it. So for purposes of taxation, the Constitution provides the ultimate law for which, the supreme law for which all taxes are therefore based, and any procedures against which any matters in relation to tax will be. Then this is broken down to several statutes, but for purposes of our discussion, I will limit it to the Tax Procedures Act, which effectively governs the procedures for taxation, filing, due dates. In case of a dispute, how is the same resolved? If there's a penalty, how much is it? If there's an interest payable or not. Then we have the Income Tax Act. This basically covers all taxes in relation to the income of the individual and the income of the non-individual entity. So be it a company, be it a branch, be it a cooperative society, be it a partnership, and all matters as it pertains to how that tax is computed, how you determine what is taxable or not, and then how much you get for relief or tax credits depending on the nature of that specific income. Then there's the Value Added Tax Act, and this is effectively on the supplies that are made by people who've registered for VAT, how the same is applied in relation to the VAT that is charged on the person who is subsequently supplying a product or a service to the ultimate consumer, how the input VAT is claimed versus how it is charged on the ultimate customer. Because one thing you have to understand is that VAT ultimately ends up being paid by the ultimate consumer of the good and the service. Excess duty will cover anything in relation to manufacturing and the services that are for which excess duty is payable. In most cases, it wouldn't really affect most SMEs because the services are so specific to certain industries and the manufacturing of certain products. So for service industry, you will rarely find, for a small scale service industry or a small scale manufacturer, you rarely find certain elements of accessible products or goods or licensed activities. But if you do have a question and it impacts on your business, feel free to raise it and we'll address it as we go on. Then the final one is the East African Community Customs Management Act. This effectively covers all customs, anything in relation to import and export, and anything that is related to that specific tax. So be it input, be it customs duties, be it export duties where it is applicable, be it the cost that you're using for importing, if there is any VAT applicable in that specific import, if there are certain reliefs that you would get. It also addresses any issues that will arise from a customs perspective in relation to the taxation procedures, a resolution of disputes, and any other thing that pertains to non-domestic tax activities. So we have on one hand the domestic taxation, which affects everything that happens in Kenya. Then we have the Igma and customs, which addresses customs regime. And this involves anything that comes into Kenya and anything that goes out of Kenya in relation to export and imports, and also on special economic zones and export processing zones, which are effectively, for all intents and purposes, under the Igma, deemed to be outside Kenya. The next slide, please. So the most common entities, business entities that you'll find around are usually dependent on the operation and the objective of the business. So you can have a company which you register as a resident company. This can be done by advocates for you under the Companies Act. You can have a subsidiary of a company. So you can have a local company and then establish a subsidiary of the same. Maybe if you want to do different businesses under different companies, you have one holding company, then small entities that derive certain business operations. You can also set up a company as a subsidiary of an unresident company, depending on the operations that you now want to sell or the supplies you want to give in Kenya. Then the third one is a branch. So basically a branch is, for all intents and purposes, the same entity as the entity which is non-resident, but effectively operating and registered in Kenya as a representative or a liaison or as a distributor of services or goods for that non-resident entity. So the difference between a subsidiary for a non-resident is that for subsidiary, it's deemed to be a resident company in Kenya and therefore taxable under a different regime, whereas a branch is deemed as a non-resident entity, and therefore there are certain obligations that come with it, and even a different corporate tax rate that is applied for purposes of it. So a branch effectively creates a presence of the non-resident entity within Kenya, whereas a subsidiary is a Kenyan entity. Then the fourth one is a partnership. So this is also governed under the law. And you can have a regular partnership or a limited liability partnership, depending on your adverseness to the liabilities that somebody would want and the partnership would like. So you can't have two individuals being partners. You can't have a company and the individual being partners. So effectively what happens is how then the operations of the business are driven and the purpose for which you set up this specific entity. Then finally is the sole proprietorship. This, in most cases, you'll find is the most common in micro and small enterprises because sometimes you find that the individual is the business. So you have Wilfred Alambo trading as Wilfred Alambo Enterprises and not necessarily Wilfred Alambo Limited or limited liability partnerships. So the sole proprietorship is effectively that individual behind the business. And so all assets, all liabilities, everything in relation to that specific trade solely falls on that specific person. Next slide, please. So the entity that somebody sets up is definitely dependent on all these specific instances and issues that they have to address, the business objective that they have, and the ultimate goal of the business. So is it if it's liabilities that you're planning to manage, you'll probably go for a limited liability company or a limited liability partnership. If it's a business that probably has certain nuances respective of licensing operations, you may decide, let me go for a subsidiary instead of a limited liability partnership, because now those objectives are the ones that drive what business you set up. But ultimately, whatever nature of business entity that is set up, the taxes that impact you as an individual business or as an individual sole proprietor will be determined by the provisions of the acts that I had mentioned earlier, and therefore the taxes that are effectively applicable in Kenya. So the taxes of concern for an SME would actually be divided into two. So I have direct taxes, and I've also now divided this to indirect taxes. So your direct taxes are those taxes that impact on you as a business or as an individual running that specific business. So you have your direct taxes, which are divided into turnover tax and your income tax. So your turnover tax is basically a way of trying to minimize the compliance requirements for purposes of a business. So turnover tax was introduced some years back and then removed, then reintroduced in 2020 at 3%. Then the rate was subsequently reduced to 1% of your annual turnover, where you have more than 1 million in turnover. We call it gross sales, but still less than 50 million. So it was effectively to simplify the obligations that will be required for purposes of a business with certain specific exemptions to ensure that you comply with the tax on a one-off basis, because turnover tax is final. Then on the other hand, we have income tax. So income tax is divided into corporate income tax, personal income tax, and withholding tax, which is more or less an agency tax, depending on the specific service that is offered. Under the indirect taxes, we have VAT and excise duty. And as I mentioned, excise duty is so specific to certain services, certain products. So you'd almost always never encounter it under an SME. But if you do, we can give comments on that too. Under VAT, we have withholding VAT. So this is a recent development. It had been there before, but effectively drives compliance. So what happens under withholding VAT is that if you are to charge somebody VAT and they are registered as withholding VAT agents by the Kenya Revenue Authority, so you charge them 16%, they would withhold 2% of that 16% that they were supposed to pay you. And in that instance, therefore, remit, you will get your 14%, but they will remit 2% directly to KRA. So that generally gives you a brief overview of what we are anticipating and what we're expecting to talk through during this session in relation to taxes. So as I'd mentioned, turnover tax is one of the most common taxes for a small and a medium scale enterprise. And it is basically charged on your gross sales. So initially, it used to be 3%, and there are those pains that people raise, and especially the fact that sometimes if I had decided to go the normal way of accounting for my taxes, then I would probably be paying more tax as a turnover tax at 3% than I would at 1%. So the government therefore adjusted the rate to effectively address this pain point, because you're saying you're trying to simplify taxation, but also ensure that people comply. Because generally what we've seen as an attitude towards tax, if compliance becomes too tedious, becomes too painful, then people tend to evade it all the same. So you try to encourage business, but also try to encourage compliance. But turnover tax does not apply to every business. So I'd said it is if your turnover is more than $1 million, but less than 50 million in a year. But it is actually paid on a monthly basis. So you take your turnover, top line, for May, do your 1%, pay the tax by 20th of June of the subsequent month. If your revenue is below 1 million, then you don't fall under the turnover tax regime. If it is above 50 million, you also don't fall within that specific regime of taxes. It also excludes employment income. It excludes rental income. And if you offer management and professional services, then you're also excluded from the turnover tax regime. And if you have any income that is subject to withholding tax, so these are your dividends, your interest, your professional services, your royalties, you don't also fall under this regime. So somebody would ask, so is it a mandatory requirement, or how do I go about it? So by default, if your income is not exempted, and if your income is above 1 million but below 50 million in a year, then you fall under the turnover tax regime. But you may opt on application to write to the commissioner and tell the commissioner, I don't want to fall under this regime. I want to be on the normal tax regimes that everybody else in. So if you're a sole proprietorship, you'll probably be taxed against your income bands for the year. If you're a company, you'll probably want to go under the normal regime for CIT. Next slide, please. So if this effectively addresses the turnover tax angle of it, and you'd wonder, so why would I want to do turnover where I can do the normal regime? So where you want to do the normal regime, which call it corporate tax or individual tax, depending on the nature of the business that you're carrying in, the 1% will have to be balanced by the expenses that you have. So for instance, if you're saying my total expenses, my net profit adjusted for the expenses, then I do the 30% or apply the tax bands for personal taxes, is still less than 1%, then it would be advisable for you to do the normal regime. Then it doesn't make sense for you, even if you're saying this is a simpler, more convenient way of doing my taxes. So you have to balance between the convenience of compliance versus the tax that you're supposed to pay. So if on a financial base, then therefore your total tax that you pay. So sometimes it's not possible, but sometimes if your 1% is actually more than your net income and you do your 30% if it's a business, then somebody would actually recommend it's better for you to therefore then transfer from TOT, turnover tax, to the normal regime. If on the inverse, 1% is less tax than what you would otherwise pay, then it makes all sense to take advantage of the simplicity of compliance and the simplicity of computation to do turnover tax. So the second one is corporate tax. So I have both corporate and individual tax. So corporate and individual tax is charged on the income. So you have your individual income tax and you have your corporate income tax. So corporate income tax is where the business model that you have is effectively an individual person. So for purposes of law, persons, both individuals and companies and any entity that has perpetual succession. So you'll find, for instance, a subsidiary company. So you have your taxes that you take your expenses, you have your income, you less the expenses that you've incurred. So basically you take your accounting profit, then the income tax provides for which expenses that you might actually be allowed to deduct from your business. And these expenses then give you the net taxable income. So this income forms the basis for you to apply the 30% if you are a resident company, the 37.5 if you're effectively a branch. If you're a partnership, then this is where you share. So the net profit becomes your net share of profit as an individual partner in this partnership. Then you now tax that income as an individual. So it goes back to the bands. So yes, you may be an LLP with your perpetual succession and all the liabilities are limited, but for partnership, the income that you have is taxed at an individual's level. So you will be taxed, quote unquote, as a sole proprietor, even if you're in a partnership. So a sole proprietorship effectively is your income as an individual. It is taxed on the bands that are provided under the income tax act. So you have your 10, your 15, and your 30%. So those bands is where you apply your income and therefore account for tax accordingly. So the due date for your taxes as a corporate, so I'm trying to distinguish between a corporate person and an individual person for purposes of ensuring I make it very clear. So for corporate person, your annual, because taxes are counted annually, your annual obligation will depend on your calendar. So if you're a December year-end, January is your first month for business. If you're a August, May year-end, June becomes your first month. So it always goes with how you've registered as with the registrar of companies, or if it's a society or if it's a cooperative, that becomes your calendar year-end. However, for individuals, the taxes, you account for them in the normal calendar year, January to December. So for instance, if you're in business and you're a sole proprietor, then your first month is January. Your last month is December. So unlike a corporation where you have installment taxes, now nothing actually stops you from paying installment taxes on the respective specific provisions of the law, but your tax will still be accounted under the 10%, 25%, 30% bands as an individual. So your balance of tax, so assuming you don't pay installment taxes, your balance of tax will be due on 30th of April. Now, when you pay, when 30th of April arrives and you're doing your taxation for the year, by the time most people usually understand that their tax is due is when they're filing their return on 30th of June. So 30th of June is the deadline for you filing your return. However, the tax that is due from you was supposed to be paid by 30th of April. And for a corporate, it will be the 30th of the fourth month of the calendar year that, depending on how you've registered for your calendar. Then, if you want to, I'd say, if you wanted to opt out of the TOT, you can to go into corporate and maybe even an individual go as a sole proprietor. But this balance depends on how best your interest from a tax angle you're viewing it. Next slide, please. The next tax that I want to highlight is withholding tax. This applies where you offer certain services as an individual, or where certain services are offered to you as a business, as an SME. So in most cases, you'll have consultants. For instance, it's usually the most common service that will be offered or received by an SME. So withholding tax for management of professional services presently is 5%, and this includes consultancy. And for commissions, if you're the one offering or receiving the service, because it's also a common mode of payment for purposes of SMEs, it's also 5%. So what happens is that if you're the one paying for these services, then the obligation for you to account for that tax falls on you. So if, for instance, you are to consult Alambo for his services, he comes and provides tax health check review and tells you these are the gaps in your business for purposes of your taxation, and this is my invoice of 100,000, then you are obligated to withhold 5% of that 100,000 and remit it to the Revenue Authority, to the Kenya Revenue Authority. So this is an advance credit on my part as a person offering the services and receiving the payment. For you, it's an agency obligation as a person making the payment. And you have to make the payment by 20th of the subsequent month. If you don't, however, then KRA can come to you. It will no longer come to me as a person who received the payment. It will come to you as a person who made the payment and say, you paid Alambo 100,000, but you did not withhold 5% as it is required under the Income Tax Act. So give me that 5,000 and I will penalize you an additional 5% of the 5,000 and then do a 1% interest for every month that since you made that payment. So yes, you might assume that that is not your obligation, or sometimes the contract might not state it categorically. But this is also one area of tax planning that you pick as you go along, because the moment the Revenue Authority knocks on your door and reviews all consultancy payments that you've done, it will not go to the consultant. It will come to you as a person who made the payment and therefore require you to pay that tax that you ought to have paid at that particular point. This also happens with commission, because you'll find that most SMEs also pay people commission. So if it's a local payment and it's anything above 24,000 shillings, because the Income Tax Act has a limit, a minimum amount for which you must start accounting for withholding tax. So once you pay anything above 24,000, you deduct your 5%, you remit it to KRA. You don't deduct and just keep it. You have to remit it to KRA and then pay that person the 95%, so less the 5% that you're supposed to withhold. On the other hand, if you're the one offering those services, the person who is making the payment are required to withhold from you, but to you, that becomes an advance tax paid to the Revenue Authority. So when you're doing your return, you cannot file a nil return, for instance, after you've made, let's say, 1.5 million shillings for the year, because on iTax, your ledger will show that there's a 5% of this 1.5, even if you had used 1 million. So you have 50,000 as a tax credit. So how is it that you're filing a nil return? You must have made certain income. So that is also a compliance gauge that the Revenue Authority has been using to ensure that people who offer certain services, people who subsequently also charge VAT, are able to account for the turnover that they have generated for that specific period. If you can go to the next slide, please. So on the contra, we also have value-added tax. So VAT is more of an obligatory charge depending on the threshold of turnover that somebody has and the type of service that they offer. you'll find that most MSMEs have what we call vertible services or vertible supply. So you're basically selling something that is subject to VAT. The moment you hit or you expect to hit more than 5 million shillings in a year, you are required to register for VAT. The practice was before iTax were people charging VAT, whereas they're not even registered for VAT. So you have a product that is 100 shillings, you charge VAT, the customer pays 116 shillings. You have your revenue as 116, but ideally that 16 is not even your revenue. It's supposed to have been remitted to the Revenue Authority. So now iTax has tends to effectively ensure compliance towards this regard. So you may register for VAT as a voluntary person doing business. For individuals operating a sole proprietorship, I would say sometimes the requirements for compliance become too hectic. And therefore, if you don't meet that threshold, it doesn't make sense for you to register for VAT. However, if you are a corporate entity, if you are a limited liability partnership or a company, then even if you don't meet the 5 million threshold, it will be advisable for you to register for this reason. And this is my personal opinion. When you buy something as somebody who is registered for VAT and this thing is subject to VAT, then you're able to take advantage of the input claim that you have and effectively transfer it to your customer. So if something is 100 shillings, you will pay for it at 116. And let's say if your markup is 10%, if you're not registered for VAT, you'll do a markup of 10% of 116 because you cannot claim the 16 that you paid as input. However, if you're registered for VAT, you're able to put your markup on the cost of 100. So which does one of two things. First, you're able to claim your 16% that you paid your supplier, and then your markup effectively makes your product more affordable compared to somebody who is not registered for VAT. So sometimes somebody would think this guy is giving people a discount of 16%. Actually, you're not giving a discount of 16%. It's only that you've planned your affairs in such a way that the VAT that you paid, you claim as an input when you're selling to this other person. So you'll do 110%, you'll do 110, then apply 16% VAT and sell it to that person. So you have an advantage of 16% of 16%. So your product in the strictest sense is the same product as somebody else. The only advantage you have is that you've planned your VAT affairs to an extent that yours looks cheaper to the customer than it is for the other party who is not registered. Of course, there are those obligations that require you to file your returns, do everything. This will be probably made easier when the TIMS regime comes in. So TIMS is basically a tax invoice management system that has been introduced by the Revenue Authority to try and facilitate compliance across. So it will link up with your ESD at your offices, at your business premises, and your iTax ledger on iTax. So it's supposed to encourage compliance. So now that balances how you want to manage it. Because when you have your input claims, you still have 6 months to ensure that you claim it. Because if you don't claim it within a certain period, then you also lose it. Then there are certain input claims that you cannot. We call them prohibited claims. So maybe it's entertainment, maybe it's food and certain things like acquisition of motor vehicles. So those ones, depending on the service you provide. So for instance, if somebody was out of town and they claimed meals, and in that invoice they've been charged VAT, then if they're out of town, they can claim the input as part of the business expense. However, if let's say you operate in Nairobi, Upper Hill, and you just went and had a meal at Bonds, then that will not be claimable as an input. But it is an expense that now would be claimable from the other side as a corporate tax expense, and which now makes us, if you can move to the next slide. So I did indeed speak about the rates. So you have your for zero-rated supplies, you have your 0%. For general supplies, you have your 16%. And if the supply is not subject to VAT, then you don't charge supply. And before I talk about the tax planning initiatives, I wanted to talk about borrowing from the corporate and VAT registration. So for zero-rated supplies is where you offer a taxable supply to either somebody who is not subject to tax, so they are exempt from tax. So you're offering something that would otherwise charge for 16%, but this person is, let's say, the embassy of the US. So you will not charge them the 16%. So you claim the full input that you would have bought when you're doing when you're now making the supply to the embassy. Then if you're making supplies that are effectively under the second schedule, so it's a list. What happens with VAT is that everything else that is not specifically put as either zero-rated or exempt is 16%. So it's like an exclusion list. So if it's not in the second schedule as zero-rated, or it's not in the first schedule as exempt, then it is 16%. Of course, other than for fuel and petroleum products, which are 8%, and depending on their nature of business, then those ones are 8% as provided and under the law. If you can go to the next slide, please. So I've touched on certain areas and where somebody can manage their tax affairs for purposes of ensuring that they plan their tax affairs properly, efficiently, and therefore manage any compliance gaps and anything that is effectively going to affect and impact on their business. Next slide, please. So what is tax planning? And I've highlighted some on when I was discussing withholding tax, when I was discussing corporate tax, and when I was discussing VAT. So basically, tax planning is where you look at your affairs and your financial situation, and then you try to reduce the impact your tax expense. So you're not evading tax. You're not refusing to pay tax. You are looking at the impact your tax expense has on your business and your financial situation. Then you now go back and review what the law provides for you in relation to the benefits that you can get, the incentives that you can get, the deductions that you can have that you've not been taking into consideration. So if you're paying, for instance, 100,000 in taxes, but you have a car, for instance, that you use for business and personal affairs, then let's say 50% is personal, 50% is business. Nothing stops you from basically illustrating that I incur 10,000 shillings per month on this vehicle. 50% of that 10,000 expense is actually for business purposes. Therefore, you are allowed to take this 5,000 that you use for business and apply it as a business expense and not a personal expense. So you effectively reduce the taxable amount that you are paying of 100,000 by 5,000 shillings. So that is planning your financial affairs. So if you are, for instance, you are an individual, you are a sole proprietor, and whatever business that you carry includes meeting clients and meeting customers or suppliers, but you use your personal, I would call it personal money, for this business that you're creating, for which you're generating income, which ultimately you pay for, you're paying taxes on. So nothing stops you from having this as a business development expense, because if you can effectively show that this lunch that I had with Alambo was to consult on certain tax matters. Yes, I'm the one who footed the bill. It is 3,000 shillings. But this 3,000 shillings, strictly speaking, is a business expense. It's not my own business, my own personal expense as Ken. So I transfer that expense to my business account and give it attach the invoice to support and justify it and give it a proper description, which therefore moves my 3,000 shillings, which was supposed to be out of pocket, to the money I was supposed to pay Kenya Revenue Authority to generate for Kenya Revenue Authority 100,000 shillings. So basically, the expense that is allowable as a deduction effectively impacts on what you're saying. I've given the government 100,000, but I must adjust for the following. So the reason why tax planning has become an issue is because we're trying to manage and balance the desire to keep your tax liability low versus the pressure that the Kenya Revenue has. So it basically allows you to manage legally, to manage and arrange your affairs to maximize on what you're getting. So the justification is, yes, if I put this money on other capital generating income, then even the government ultimately in the long run will get higher taxes because I will improve my profits, I will generate more income, and therefore the government will get more money from their business. If you can go to the next slide, please. So how do you tax plan? If I would highlight and summarize what I've already spoken about. So the first step is compliance. Comply, comply, comply. If you are supposed to pay a certain tax by a certain date at a certain amount, ensure you pay that tax when it falls due and at the correct amount. This does two things. One, it ensures that you're complying with the requirements of the law. And then secondly, you avoid instances where you have penalties and interest that will accrue to you. Because the 5% penalty that will be hit on you by KRA when they come, or the 1% interest on the outstanding amount, is a cost to your business, and it is a tax cost. So even if you are to pay it, you cannot claim it as an expense in your business. So it's gone. So compliance becomes fundamentally the easiest and cheapest way for you to ensure that you're planning your tax affairs properly. Secondly, engage consultants. If you cannot engage consultants because they will always have a different perspective to your business, then engage an in-house tax team that can always reach out, because almost all tax departments in the country will always have somebody else who has a similar issue, who will reach out and ask for a similar query. These days of WhatsApp, people are in the same WhatsApp group, somebody will have a quick issue and they will ask across. So have somebody other than you who is dealing with their tax affairs. So you can have an accountant who combines and also is both the in-house tax person, the finance guy, depending on the size of your business. But if you can afford it, or there are also some tax consultants who you would be affordable for you. You don't have to go to KPMG if you cannot afford the KPMG. You can go to that tax consultant and ask them as to certain tax matters for maybe at a reduced fee. You can also go to a KPMG consultant and maybe during, you probably have a friend or a colleague somewhere during lunchtime, you buy them lunch and ask certain tax queries that might give you insights on certain things that you may implement subsequently. The second thing is manage your expenses. So like I said, the instances where a consultant will tell you, I will charge you 100,000 net. So when they charge you 100,000 net, it means if there is a withholding tax obligation that comes, you are the one who is going to pay it. So we call this tax grossing up. This person, you're paying 100,000, you're also paying their taxes. It doesn't make sense for you to pay their taxes, whereas they will take that tax credit when they're filing their return. So if somebody is telling you 100 net and they have a credit, so unless they're telling you to bear their tax expense and also pay them, if it were up to me, I would say, no, this is your tax obligation. I'm just an agent for purposes of withholding. I will withhold 5K. I'll pay 5K to KRA. You'll get your 95,000. You go arrange your tax affairs also independently. The other one was on VAT. The one I was saying, you manage, if you can register for VAT, register for VAT, because you'll be able to claim the input based on the provisions of the VAT Act. So it reduces your cost by 16%. It makes your products affordable because the base of your margin or markup is also reduced. If the expenses that are non-deductible, do not have them in your books. So for instance, if you're making, right now the law has changed, if you're making a donation to somebody who is not registered, then you would have to provide, and you would have to have an invoice to be able to claim that specific donation. If you don't have an invoice, then even if it's a charitable organization, regardless of how the entity that it is, can be registered as a company by guarantee or a society or a trust, whatever it is, then they will give you an invoice for that donation, and you can claim it from the Revenue Authority as a business expense. So you ensure that these expenses that would otherwise be rejected are actually transferred and justified and effectively supported by a proper document that will now allow you to claim that expense in your books, be it as a corporate company or as an individual. Then maybe you're a sole proprietor. You have a team of 5 people. Yes, you want to give your team members a reward for their good performance in a year. Nothing stops you from organizing a business strategy meeting in Mombasa at White Sands Sarova and then expensing this as a business expense. It doesn't have to come from your pocket, because whatever these people have done and whatever strategy you're going to do is effectively what is generating more income for your business and therefore subsequently more taxes for the government. So this is a legitimate business expense, which you can actually, once able to justify, deduct it from your profits and therefore get a lower base for applying tax. So if you're in the import business, for instance, sometimes people, the back and forth, you have not prepared well. So an import comes, you have your products at the customs office. You're incurring demurrage costs for a product that you will ultimately pay for, and this cost you will ultimately have to pay for. So if you can arrange your affairs to such an instance that you spend the least amount clearing your goods, then that is a way of also managing your tax affairs. You're managing your VAT, your import duty, all these other things. You are reducing your demurrage costs. If the income, that's in relation to the income. And now in relation to expenses. On the income side, there are certain things you can take advantage of, and depending on how you classify it. So if, for instance, you're an individual who has an insurance policy, the law allows you to take an insurance relief. You can look at it as an income from an angle in the sense that it reduces your taxable amount that you're going to pay to the government. If it your building that you're using is a personal mortgage, but 50%, 60%, 80% of it is used as business, nothing stops you from allocating certain expenses towards the business, but still end up taking a relief, a mortgage deduction for the same product as an individual, because it is your building. If it is a company, nothing stops you as an individual to rent out the company, to rent out the building to the person running the business. So there are those instances where you can manage your affairs properly, where you can transfer expenses, where you can take incentives by just using the law as it is. And this therefore makes it available for you to have more personal income as an individual if you are a sole proprietor, or if it's a partnership or a small company, rather than having expenses that would otherwise go to the business, but you're accounting for them as individual expenses. So if you're a director of that company, the company can pay you a salary, or you can be a non-salaried company, but certain business expenses can be settled by the company itself. The law allows you, as long as you're able to justify that this expense that I've reported was used to generate the income of this specific business. It can be a one-man company, but it is a company still. So it's a single director, it's a single shareholder, but the individual Alambo and Alambo Limited are two different persons for purposes of tax. So the businesses, the expenses for the business are for Alambo Limited. Expenses for Alambo are for Alambo as the individual. So once you're able to separate those two, then you're able to manage your funds and therefore split your personal expenses, split your personal income from the business and personal expenses. Finally, on tax planning, you have to ensure that you carry out tax health checks. Even if you can't afford for immediately, you can have a plan for, let's say, 3-4 years. Then you engage a tax consultant to just review your books and therefore give you a sense of what the affairs of your, from your tax perspective, the affairs of your business operations are. When you're doing your budget or you're getting into contract, nothing stops you from reaching out and asking, what is the impact of tax on this specific contract, on this specific budget, on these specific things? If you have provisions, maybe you have debtors who are not settling your debts, the law allows you to write off those debts instead of carrying them in your books as provisions. All you need to do is be able to show that based on the guidelines that the commission has given, I cannot recover this debt, or this person is since deceased, or this person, for whatever reason, cannot afford to pay this specific debt. They were declared bankrupt, so I cannot recover. The law allows you to expense that specific provision. And if you had paid VAT, for instance, and you're a VAT registered person, 5 years have passed, this person has never paid you, you already paid the 16% to the Revenue Authority, which means you have money at the Kenya or the government, but the person, the debtor didn't pay you. You are allowed to go and claim refund on this bad debt. So you have to maximize on all possible opportunities to facilitate your cash flow, but at the same time, ensuring you're within the provisions of the law so that nobody comes to penalize you for basically running a business. If you can go to the next slide, please. So based on this, the provisions of the law and the affairs and business operations of an individual as a business, it's almost certain that you'll always get into a dispute. And this is because you will plan your affairs the way you're planning your affairs within the confines of the law. The Revenue Authority has targets and it must meet those targets. The government is facilitating your business and therefore must get taxes for purposes of running and ensuring that the environment you operate in is convenient. So there is always going to be conflict as to how certain taxes apply, how certain provisions of the law that I had mentioned earlier are interpreted. And therefore, because of this aggressive nature of the Revenue Authority and the tax, minimizing your tax liability as a business, you'll always find yourself at a dispute. And tax disputes will always be there because, like every other thing that can be said, there's nothing as certain as death and taxes. And that is a quote by Benjamin Franklin. So taxes will always be there. How you manage your affairs to accommodate the same while ensuring that your business still operates and compliantly, you'll always end up having that specific dispute. So yes, the dispute will be there, but you must resolve it. Otherwise, the alternative is to close shop and go. So that is now effectively what I'm going to discuss in the next few slides on tax dispute resolution. So tax disputes and everything around it is based on the Constitution, because there is no tax or fee or anything that can be imposed on you. As I had said, the government can't do anything other than that which is provided by law. You as an individual, you can do anything, but the government cannot do anything other than that which is prescribed by law. So you cannot only do things that the law prohibits you from doing it. So if the law says do not do this, then you cannot do it. But if there's no law that says do not do this, then you can do it. On the other hand, for government, the law has to say the government will do this for the government to do it. Otherwise, the government cannot do it. So if there's no license fee, there's no tax, except as provided in law, then the government cannot demand for it. And this is now, therefore, why audits usually happen. Next slide, please. So tax dispute drivers are effectively driven by the procedure of tax. So the Tax Procedures Act basically harmonizes and consolidates all the laws that you have. We call them the tax laws, which are effectively specifying what you need to do when your tax is due, how much you need to pay, and if you don't pay, what will happen to you. Next slide, please. So these tax laws is the Income Tax Act, the Value Added Tax Act, the Excess Duty Act, the Miscellaneous Fees and Levies Act, which all incorporate the fees, levies, taxes that you're supposed to comply with under the domestic tax regime and any regulations that come with them. Then on the custom side, the next slide, please. On the custom side is the Igma. So the East African Community effectively deals with all customs affairs for businesses that you do when you're still in Kenya. So be it import, be it export, maybe you imported something that is supposed to be paid duty at 25%, you put the wrong code, it ended up at 10%, KRA will demand for the 15%. If it's maybe a vatable at 16%, but you did not charge VAT, you did not pay VAT, KRA will come out and tell you, you owe us 16% on this import. If it is an undervaluation, KRA has a right through the customs office to review the product, value it, and then uplift it. We call it a product uplift. Next slide, please. So any audit that will be done, both domestically or under customs, has three main stages. So this is the first pre-audit stage, where they'll give you the intention that they want to look at your books, they want to look at your affairs, they will request for information, and which may determine whether or not they actually come and review you. You have your returns that you filed. This can be done on a desktop review. So you filed a nil return, but you have withholding tax credits in your record. Nowadays, iTax effectively refuses to make you file nil returns if you have credits on the system. So you've paid consultants, but you've not withheld tax. There is no withholding tax certificates on your ledger that you've issued. So all this effectively now drives what they need to do, what they need to look into before they come for the audit. Sometimes it's even a disgruntled employee who has come and said, my employer doesn't pay taxes, they withhold PAYE, but they've never remitted, I've never seen it being remitted. So those are the information that will be now given in relation to the same. Now, then comes the audit. The audit is effectively the full review. You understand the business, they ask questions, they ask for supporting documents. You say that the lunch you had with Alambo was a consultancy, or was a business consultant meeting. So how do you link it with the business? He later came and taught my finance team on how to file returns. So that's why the invoice is part of the business. So you provide this information, you provide clarification as they carry out the review. Then after the review, then there's a post-audit period. And this is the time when the findings are given, clarifications on assessments are provided. So during this process, all the process, you have to ensure that you're on top of it. If you cannot do it yourself, then get a consultant to assist you. One thing I've always discovered is that on matters audit, immediately you get an intention to audit or a query from KRA, get a consultant and ask, what does this relate to? What are they looking for? Don't come out to volunteer the information, because you might not be conversant with the provisions of the law that they require, and nothing under the law stops you from consulting on an audit query from KRA. So yes, it's confidential to your business, but you as the business owner can reach out and ask somebody, I received this letter requesting me to provide certain clarifications. What do you think? So once you do that, then it gives you a perspective on what you need to do. During the whole audit, you have to ensure you provide clarification for information. Don't withhold any information on the basis that you're feeling like, if I give this information, I'll be penalized for it. If you're compliant, you're compliant. If you're non-compliant, you're non-compliant. There is no two ways about it. So if ushikwapo shikamana, if I would say so. So once the query raised effectively makes you understand that there's a compliance gap here, you talk to the revenue authority through your consultant or through your inside tax team. You tell them, yes, we did not withhold tax for the following reasons. We request that if you can allow us, let's pay the principal tax. We'll apply for the waiver of penalties and interest. The law also allows you, if it's a demand for 500,000, you can tell the person, I can only pay 100,000 for the next 5 months. So they will always allow you to do that. However, if there is nothing to pay, or if your issues is in relation to conflicts of interpretation of law, then you do not have to agree with all the assessments that they'll give. Now, this takes us to the next stage. Next slide. So I'd already mentioned the place of audit. So it can be a desktop audit, it can be a fixed field audit, it can be a mixed audit. So this it depends with where the audit team is sitting. Next slide, please. So this now takes you to the next stage. So what is the extent of audit that the KRA is doing? Because it can be a compliance audit. Is the return proper? Is the amount paid correct? Was it filed by 20th? If it's due on 20th, was it filed on time? If it's not, what are the penalties? So compliance audits are basically checklists for things that you must do under the Tax Procedures Act. There is no way you can run away from it. So yes, you filed by the due date, but you did not pay. So you still have outstanding taxes to pay. So that is a compliance gap that you have to fill, and it's the cheapest way of managing your tax affairs. Just comply. It's the cheapest way to manage your tax affairs. Then normal audits are general audits. These ones will always happen whether or not you are a compliant person. So the Revenue Authority has up to 5 years to review your books. They might not come within those 5 years. They might come on the 5th year and review the last 5 years. So this is a normal audit. It's under the law. It's provided under the law, and there's nothing you can do about it. If you're compliant, you'll get your clean bill of health. If you're non-compliant, the gaps will be noted. If you're conflicting, those conflicts will be highlighted. In-depth audits are usually where there is a certain industry issue that the Revenue Authority has identified. So you want to go, if somebody is paying commissions generally without withholding tax, then you go find out what this is happening. Are these people employees? Are they consultants? Are they sales agents? Or what are they? This person is providing services, but they're filing nil returns. So it's basically a review of your business, and it can be a mix. It can be very thorough. It can be over. It can be targeted. So it's basically sometimes it's somebody who has blown the whistle on you, and they've said you don't do certain things from a tax perspective. They want a cut of that. Or it can be an investigation where the Revenue Authority feels like you're deliberately evading tax. So they want to come and look at your operations and affairs to ensure that you are complying with the tax requirements. Next slide, please. So why seek professional assistance? Because this person will give you a different perspective. If you get a demand for, let's say, you have employees, but you've not paid 500,000 in taxes. So KRA demands 500,000. If you take it to Ken as a consultant, he'll look at it and tell you, you have 10 employees, so how much do you pay them? Then you look at the numbers, you find that actually your employees are paid 20,000 shillings per month, which effectively means, therefore, they're not supposed to be paying taxes in the first place. So there is no PAYE applicable to them. So the offense you've done is not file a return for PAYE. It's not that you've not paid the tax itself. But since maybe you did not consult, you decide, let me just settle this matter and close it. Or let's say we'll pay the principal and apply for waiver. So it's not necessarily always true that the KRA is correct. So sometimes it's because they don't understand the business itself. Sometimes somebody has withheld VAT from you and you're not registered for VAT. Then you go to your iTax, you find a withholding tax certificate of, let's say, 100,000. But you're not registered for VAT, so you don't charge VAT. And maybe even the turnover threshold that you are supposed to get, you're not even there. So you go and do the check, the person looks at your books, sees you're not registered for VAT, then you're told this is an erroneous withholding, you didn't even charge VAT. So KRA cannot demand for the remainder of 14% because your turnover did not even include that 16%. So because if that person withholds 2%, the assumption is you charge 16%. So KRA will come and ask you, where is the 14%? So that is why you need somebody else to have that business idea and advice on these implications. Then at a kickoff meeting, when you're defining the scope, the time frame, the chain of request of information, this person is able to effectively act as your buffer. So engage KRA on what they're doing, what they want to find out, what information they require, what timelines are there. You cannot review me for 10 years. You have to give me a time frame. You can come in, do your review for 1 week and go, then give me results later or seek clarifications and everything. Yes, as a person, as a Alambo, I know my business better than anyone else. But when it comes to certain matters, you'd rather best leave it to somebody else to handle. And that's why at the kickoff meeting, this person is emotionless, if I may say so, will be able to deal with all these issues and define the scope. Then thirdly, this person is able to assess the risk for you, and they're able to tell you, these are the things that you need to look at. And I will rush through them in the next slide, yeah? So I'd mentioned the depth of audit. Next slide, next slide. Next slide. Yeah, so we'll assess the risk. So if it's a PAYE or a statutory reduction, have you filed on time? Have you computed it correctly? If it's corporate tax, if it's withholding tax, have you complied with the provisions of the law? If it's VAT, have you charged VAT where you're supposed to? Have you accounted for output VAT? Are you claiming the right input VAT? If it is transfer pricing, will probably not affect most MSMEs, but if you have related party, if you are a subsidiary of an unresident entity outside there, how are you managing this too? How are the prices coming along? If it's customs duty, have you put the right HS code? Have you paid VAT when it was due? Is it the right duty? Are the levies proper? If it's regulatory compliance, have you paid the licenses that you're supposed to pay? Have you complied with the regulations that have been given? If you are subject to OSHA, are you compliant with OSHA? If these other regulators, have you done all these things? So this person is able to address those issues for you and tick in the gaps and effectively address the gaps for you from an out of business perspective. Because since it's your business, you tend to be emotional, you tend to be aggressive with it. Then this person will give you that highlight of what you need to do. Next slide, please. So based on that analysis that they've done, then you're able to measure, is this a low risk issue? Do I need to address it? How significant is it? So this is basically those issues that you need to take note of. And yes, you may find your wiggle way through. And maybe if it's a reconciliation item, now put in reconciliation measures. The amount of VAT that you've charged versus your turnover do not reconcile. You understand the gaps. You manage to reconcile it during the audit, but you now have to put in things in place to ensure that that risk doesn't appear again. Then the others that you note that have potential exposures, maybe you're supposed to pay your tax on 20th, but there was one staff who wasn't included in the payroll. You ended up paying less by that amount of money, but you subsequently paid, you generated a PRN and paid more money than you're supposed to. So there are those medium risk things. These are mostly things you'll pay tax, but you can always negotiate and address as you go. Then those ones that are high risk are those ones that there is no way you can run away from them. So it's nothing to do with the law. It's just everything to do with compliance. You're the one who did not comply. It's not an interpretation issue. It's not a green area. It's not a gray area. It's black and white. So you either pay and effectively negotiate on a settlement plan, or just pay penalties and interest, or apply for the principal, apply for waivers. Generally nowadays, waivers are not given. So now, based on that risk assessment, I can assure you as a business person, you probably would not be able to do it without the consultant. So they're able to point out those gaps, such that by the time now KRA issues you with a demand, which is the next slide, please. Now, when the KRA issues you with a pre-assessment, so basically you have cleared all outstanding matters, you have aligned the information request with the information provided, you've provided all the clarifications. Now the KRA tells you, this is what we think you owe us. Or maybe you have a clean bill of health. Next slide, please. Maybe you have a clean bill of health, and therefore continue complying the way you're complying. So if it is an assessment, it has to provide very specific issues. So if it is indicating areas of clarification or requesting for more information, you provide for that. If it is tax issues that are emerging, they have to tell you, you did not comply on withholding tax because you did not withhold on the 100,000 you paid Alambo. Not just tell you, you owe us 5,000 shillings. So they have to be very specific in the category of tax, in the transaction itself, and it must be matched with the provision of law. They can't give you a letter that doesn't say they are basing it on what provision of law and what tax it is and what amount it is. So when you close it, you're either compliant, you get your clean bill of health, or you get a tax assessment. Next slide, please. So when you get your tax assessment, so you move from your notice of intention to audit, you've done all that, KRA has done its audit, you've given the information, you've clarified, you've engaged consultants, you've engaged all these parties, a demand is issued. So when the demand is issued, you have a right as a taxpayer to object to that demand. So you may pay the tax as demanded. You may challenge part of that demand. So you say, I concede to A, B, and C, but D is not, and concession is not a proper assessment. I therefore challenge it. So you challenge it under the Tax Procedures Act, which brings us to now the whole process of tax dispute resolution. Next slide, please. From whence you object. Now the audit is over, an assessment has been issued, you've objected to that decision. So the process right now is that once you object, your objection goes to an independent review of objection office. They will ask for clarification. Sometimes they'll even ask for the information you provided to the audit team. If you had a consultant, this process will probably be managed by the consultant. But if your business is you or you have an internal team, they can also manage it. But presently, the law is going to be changed. But presently, every time they ask for information, the 60 days start. So the law has always been skewed towards the commissioner asking for information. You're on day 59, you're about to close the matter. In the evening of the 59th day, they ask for information. So we start on day 1. So you do another 60 days. So the law is changing this to ensure that they can only ask for information once. So once the 60 days lapse, then they cannot ask for the information again. Or if they ask for subsequent information, the date they ask for the first information becomes day 1 of the 60 days. So it's not on every information requested. So the calendar runs despite how many times they ask for the information. So the KRA will accept your objection if it's reviewed, or reject it and tell you this is our decision, the position of the commissioner still stands, or amend it and say we agree to this part, A, B, and C. D and E, we do, however, disagree, and therefore you need to pay this tax. So then you give them a notice of appeal that I don't agree with their decision. So this you give in 30 days. You tell them I'm going to appeal this at the Tax Appeals Tribunal. Then 14 days later, you must file an appeal bundle to the Tax Appeals Tribunal. So the TAT will review your objection, get the respondent's objection, KRA in this case, measure the facts against the law. All this time, you can still engage through an ADR process. You call it an alternative dispute resolution. It's a give and take kind of process. Let me concede, because maybe this was orange for me. I think KRA may be right, but I'm strong on this one. Let me concede on withholding tax on the professional, but for PAYE, I defend it on the basis that I already paid the principal tax. It's only that it was not included in the return that I filed. So it's a give and take kind of arrangement through the ADR process. If either party does not agree at TAT, either party can appeal to the High Court. So you have your 30 days after the decision is made. If you don't agree at the High Court, you move to the Court of Appeal. And if you don't agree at the Court of Appeal, and based on a very recent decision by the Supreme Court on the ABSA case, now if the matter can be declared as a matter of general public interest and it's affecting industry, for instance, then you can even move to the Supreme Court. Next slide. So, as I insisted and keep saying all through, compliance is cheap, it is efficient, and it is effective. And the certainty of taxes sometimes makes even death scared of taxes. And with that, I think I can give it back to Kennedy. Thank you.
Yeah, thank you, Wilfred, for that informative presentation. Clearly listening through the subject is very broad, and I note we have overrun the time we had allocated for this session. I wish to thank participants for the many questions that have been posted on the chat. But because we ran out of time, we'll just pick 3 questions for Wilfred to respond to. And the other questions, we will respond directly to the participants who raised those questions. So quickly, Wilfred, I'll pose those 3 questions that have come to. The first one is in regards to the tax refund process. And maybe you can just give us a highlight of what it entails when a taxpayer is seeking for tax refund. That's the first question. Let me raise the 3 questions, then you can take them together. The other 2 questions are largely relating to consultancy business. I think there are a number of questions relating to consultancy. And the question that has come through that cuts across is for you to give examples of allowable expenses in the context of consultancy business. Then the third question, which is very interesting and touches on the East Africa community, basically region of business, is what benefits are enjoyed by a non-resident person within the EAC region. So if you can answer those 3 questions, just giving a brief because we have overrun the time, and then the other question we will respond directly to the participant. Okay, so over to you, Wilfred.
Thank you, Ken, and apologies for overrunning the time, but this is such a broad and for some of us very interesting topic. We can go on and on. So I'll take all questions and I'll answer them in the same list that you've given. So on tax refunds, basically ITAX has effectively made it easier for people to get refunds if they're able to justify those specific refunds. From my point of view, I would actually advise if you can avoid not overpaying tax, it's the best way to manage your cash flow. So pay the tax that is due correctly and on a timely basis, but also just ensure that you pay that amount that is due, because the challenge we've had recently is getting refunds from the KRA. And this is a challenge that cuts across all industries, be it in the big industries or the SMEs. So if you can, don't find yourself in that position unless it's necessary or it's part of your business. Maybe it's a refund for VAT, you offer zero-rated supplies and therefore you have to claim your input. However, the process effectively happens is that, first of all, you have to show that those taxes were paid in the first place. Once it's verified and you have your record and supporting documentation for the same, then you have to apply for a refund on ITAX. So depending on the nature of tax that it is, you'll always have to apply for a refund on ITAX. So once you've done that and the job is allocated to a specific person at the Revenue Authority, then it becomes easier for you now to subsequently follow it up. But you have to have the right documentation in place. So if it's a tax that was paid in error, you have to show what error it was and why the error occurred. If it is an overpayment of tax, you have to show what tax you're paying for, how much was due, how much you've overpaid. If it is your normal overpayment because you overpaid installment taxes, then if you can, apply for it to be set off against your other tax obligations. Because right now you can set off your installment taxes easy than it will be for you to claim a refund for the same. On the allowable expenses for consultancy businesses, what happens is that you'll find that some consultants are actually individual consultants. So it's Alambo and is Alambo Consultancy Limited doing all consultancy jobs. What you have to match, first of all, is the expense related to your business. So assuming you're a consultant who purchased a laptop that you use for purposes or as a tool of trade, most people will have that laptop as if it's an individual laptop, while in essence, it's actually a business tool. So you are allowed under the provisions of Section 15 of the Income Tax Act to claim an allowance on that laptop. So you may not be claiming a depreciation when you're doing your taxes, because if it was a depreciation, then you would add that depreciation back. But what you're forgetting is that you're also not claiming a wear and tear allowance on that specific laptop. The other thing is transport. Maybe you have to go consult in Kisumu or in Mombasa, but the cost of you traveling is actually on you. So this consultant needs maybe a site review of something. You'll find that as an individual consultant, because if it was an LLP or a company, you'll probably be able to do these expenses as part of the company and get a reimbursement from the business. But most consultants, if you've already agreed of a fee of 200,000, you'll find that this is an all-inclusive fee. So if I am doing this and at an all-inclusive fee, then I should be able to deduct my expenses. If I was being accommodated, I should be able to deduct my accommodation. I should be able to deduct any expense that is in relation to this specific consultancy that I'm going to do for this specific person. Even if you can use Uber and have all those Uber invoices as part of your claim. If you have an individual car, you can actually have this proportionate allocation of how you use your car to go to the client every single day. Maybe you've been there for the last 30 days. The fuel you're burning is not your individual fuel. It's actually fuel burned to go consult for this specific person. So that is actually an expense that is supposed to reduce the tax obligation that you have. So I wouldn't say there is a specific expense that is allowed, but I would say any expense that can be directly attributed to the generation of that 200,000 shillings that you're generating is a business expense that should deduct in relation to the taxes you're supposed to pay. The other one is the benefits for entities in Igma. So other than the fact that we are considered one custom zone, all business benefits that accrue in Uganda or Tanzania or Rwanda, now DRC, Burundi, South Sudan, are deemed for customs purposes. So you cannot, for instance, say you are importing into Kenya from Uganda. So there is no duty payable if you're importing from now DRC into Kenya. Now exporting to, so for purposes of customs, you are deemed to be one custom region. But for purposes of local taxes, all local taxes apply. So for instance, if you're not registered for VAT and you're offering services, you are receiving services from Uganda, you are required to pay reverse VAT. That is 16% on the service that you are getting. So this service is effectively increased by 16% as reverse VAT. But this is a service you're effectively, quote unquote, importing from Uganda. If you're registered for VAT, then you don't have to account for that 16% because now the local law applies. And in the instance that because you will claim the input, then you don't have to charge reverse, which is actually another way of managing your tax affairs and why you would probably be best off registering for VAT or not. So the only benefit you get is where you're importing from a custom partner, then it's not deemed as an import for purposes of importing outside the region. I hope I have answered that, but if I haven't, you can seek further clarification and I'll respond to it.
Okay, thank you, Wilfred, for that response to those questions. Indeed, it has been a very insightful engagement, and we thank you for the information you have shared with us. And clearly, we recognize that this is a broad subject that cannot be covered within the time allocated. We've seen requests for the recording, and we will arrange to share the recording for this session. We'll liaise with the Inuka team to see whether we can arrange a follow-up session just to address some of the areas where we were not able to cover due to limitation of time. So mine, on behalf of the KBA and on behalf of Rosalind, we'd like to thank you for your participation, for your questions, and we look forward to host another session where we will share insights on topical issues affecting your businesses with a view of seeing how to support you in your various business arrangements. So ours is to thank you, and we look forward to engage with you in the next webinar that will be communicated as usual. So thank you very much, and we wish you a pleasant evening. Until next time, thank you.